Is the Bitcoin bull run over? We're seeing some serious red candles, and a lot of people are getting nervous. But before you panic sell, let's break down what's really happening. This isn't the end of the cycle. What we're witnessing is a classic liquidity squeeze, driven by big money and a major policy shift all the way over in Japan. Let's start there, because that's the real trigger for this week's downturn. Bitcoin dipped below $90,000, and the mood turned sour fast. But the culprit isn't in the crypto charts, it's in Tokyo. The Bank of Japan is getting ready to raise interest rates for the first time in what feels like forever. For decades, Japan has had near-zero borrowing costs. This is a huge deal. Why does this matter for Bitcoin? For years, investors used something called the yen carry trade. They'd borrow Japanese yen for almost nothing and then invest that cheap money into higher-yielding assets like stocks, and yes, crypto, where rate hike completely disrupts this strategy. Suddenly, borrowing isn't cheap anymore, so those big players have to unwind their positions. They sell their assets, pay back their loans, and that pulls a ton of money or liquidity out of the market. When that happens, the market gets thin, choppy, and very unstable. History gives us a clear roadmap here. Back in July 2024, Japan raised rates, and Bitcoin plummeted 26% in just a week. Then in January 2025, they did it again, and Bitcoin fell another 25%. The market doesn't wait for the official announcement, it reacts to the expectation, and that's exactly what we're seeing right now, with this Japan situation as the backdrop. The price action has been wild. Right as the US market opens, boom! Bitcoin drops nearly to $1,000 in less than 40 minutes. We're talking $40 billion wiped off the total market cap, with hundreds of millions in liquidations. And the weirdest part, these sharp drops often happen with no major news. No obvious catalyst. The price just falls off a cliff. Almost like clockwork. This doesn't look like retail investors panicking. This feels much more controlled, almost surgical. It looks like deliberate liquidity extraction. Big players are methodically triggering stop losses, hunting for liquidity in a thin market. When this happens, confidence just evaporates. Even seasoned traders start to second-guess themselves. And smaller investors often get shaken out without ever understanding why. So, where did all the money go? It's all about liquidity. Think of liquidity as a market shock absorber. When there's a lot of it, big trades can happen without causing huge price swings. But when liquidity dries up, even a small push can create a massive move. Right now, the amount of Bitcoin being bought and sold on spot exchanges is down 30 to 40% from the levels we need for steady growth. The action has moved over to derivatives. But that's also where all these cascading liquidations are happening. The order books are thin. That means a trade of $50 to $100 million, which isn't that big for an institution, can now move the market by several percentage points in just a few minutes. This explains the sudden nosedives with no news. The liquidity hasn't vanished entirely. It's just trapped in the derivatives casino instead of flowing into the actual asset. This isn't a crisis. It's more like a compression phase. The market is getting squeezed. Now, a common question I get is, if big players want the price lower, why don't they just dump it straight down to $60,000? Well, the market is way more complex than that. This isn't 2017. We were talking tens of billions in daily volume and massive open interest in derivatives. A sudden 30 or 40% crash would be incredibly expensive to orchestrate and would probably be met with a huge wave of buying from other institutions seeing a discount. A straight crash is also just inefficient. The real goal isn't to obliterate the price. It's to slowly bleed out the leverage and shake out the weak hands. This is done most effectively in these 5 to 10% drops, where stop losses and leverage positions are clustered. A slow grind down, with a few fake pumps to trap hopeful buyers, is far more effective at making people give up and sell at a loss. Plus, for many funds, a 20 to 30% dip is a buying opportunity, not a signal to run for the hills. The game has changed. So, where do we go from here? I wouldn't be surprised to see us test the $80,000 to $78,000 range if this pressure from Japan keeps up. Those levels are definitely on the table, but let's keep this in perspective. At 25% correction is completely normal, even healthy, for a Bitcoin bull market. It flushes out the gamblers, resets the system, and builds a stronger foundation for the next leg up. We've seen these uncomfortable periods in every single cycle. The price is down. Sentiment is in the gutter. And every chart looks scary, but the mechanics behind this move are logical and directly tied to the global macro environment. Remember, the US and China are still leaning towards easing their own monetary policy, which will eventually pump liquidity back into the system. And crypto is always one of the first markets to react to that. The bases we form towards the end of the year often set the stage for the next major rally. This is a test of conviction. Don't let the short-term noise shake you out of a long-term trend. Thanks for watching, stay strong, and don't forget to like and subscribe for more updates. I'll see you in the next one.